Now that we've defined a market, let's get into market forecasting and monetary policy. Some of the key indicators to be aware of are the Treasury yield curve, the Federal Reserve federal funds rate, and the Fed's current rate projections. You'll also want to keep an eye on global exchange rates and understand why currency values are changing. Before we get into more detail on those topics, I just want to ask you about market forecasting. A lot of individuals don't have time to really look into this on an in-depth level, so what do? Well, just take a look at what the large banking and corporate institutions are doing with their money. Are they holding on to it? Are they putting it into investments? You can also look at the news and look into the financial headlines to see what are some of the big investors saying. Are they holding on to their cash? Are they investing it? Are they putting it in new ventures? Another point of reference is credit and how easy is it to get credit. So if credit is really easy to get, then the financial institutions likely believe that growth is on the horizon. In the same respect, if you go to the same institutions and they don't want to lend to you and you do have good credit, that's generally a sign that things in the economy are not doing well or that the outlook is not that good. So as you develop your financial acumen, just know that not everything is some math equation. Sometimes it's just about understanding your environment and whether or not it's the right time to jump in or out of certain investments. You can also reference a lot of podcasts and influencers to see what they're talking about, but remember that they're just speculators. They're not experts, so don't be surprised if their predictions are wrong. Predicting the market can be about as reliable as predicting the weather, and we all make fun of our local meteorologists for never getting it right. So don't be surprised when the market reacts differently than your expectations. Leveraging economics to help with your investments should make it easier to figure out where to invest and when to jump in and out of the market. And any good form strategy will include certain economic indicators that you monitor as a way to know what's going to happen next. In terms of timing the market and forecasting how and when to do that, once you understand how to monitor economic indicators and track monetary policy, the rest of it becomes predicting what type of year you think we'll have, and then aligning yourself with a strategy that benefits the most. To better understand how to do that, you have to develop an understanding of how different strategies perform over the years. And here's another snapshot of looking at that historical performance of our funds next to the S&P 500's performance from 2008 to 2020. And what you find here is that the market over time tends to do fairly well and is pretty consistent at producing returns over the course of a decade. However, there are certain metrics that in some years don't work out very well, and even when the market may be performing at its best. So all we're trying to get you to understand here in relation to market timing is that the strategy that you choose might have more to do with what's going on in the market and not necessarily be based on strictly your preferences. So it's worth noting that these metrics work better during certain market conditions, and that this table down here shows you the returns from each metric for each year. Then at the bottom, we've attempted to define the different types of years, so you can see whether or not each of the metrics performed well, depending on whether or not it was a growth year, a flat year, or some type of other market condition. One of the ways you can predict future market conditions is by paying attention to the Federal Reserve. They handle regional bank regulation and manage all of the central bank interest rates. There are 12 regional Federal Reserve banks that are located throughout the United States, and they are governed by the Federal Reserve Board, whose board members are appointed by the U.S. President. There are 7 of them, and they oversee the rules for regional banks. What they do is they work with the 12 regional bank presidents to set interest rate policy and manage how much currency is in circulation. They do that by buying and selling U.S. securities from the U.S. Treasury, and essentially what they're trying to do is to create controls that help regulate economic growth, stabilize exchange rates, and limit inflation. In terms of the U.S. Treasury, like we mentioned a moment ago, they supply the currency and handle government funding through the sale of securities. So the U.S. Treasury issues U.S. dollars based on securities that they purchase from the Federal Reserve, and then the Fed issues and repurchases those securities. They do this in an effort to manage and maintain how much money is out there. And then it's the interest rate that's paid out on those securities that are based on the federal funds rate, and that's determined by the Federal Reserve Board. Ultimately, what they're trying to do is align the interest rate policy with the type of inflation or deflation that they need in order to spur growth in the economy and to begin to get everybody moving again. Some of the controls, like quantitative easing, means that they need to buy back treasuries in order to limit monetary supply. And what they're trying to do is make the impact of an economic downturn minimal. If you think about it from the perspective that sometimes their actions may lead to millions of people losing their jobs if they don't make the right calls. So it's not an easy thing to balance, and there's no exact science to it, despite what some folks will tell you. Now, you'll always end up in market conditions with critics and people saying that things could have been prevented, but it's hard to tell, and these folks always try to do their best to coordinate with the Fed to produce favorable outcomes. Now, one of the main aspects of dealing with bond purchases is understanding the Treasury yield curve, which is a graphical representation of the current interest rate offerings. Essentially, what you need to understand is that there are a few different shapes to this. The shape is the ideal shape, and it indicates a healthy market by having the interest rates continue to increase the more time to maturity, meaning that the Treasury has a very strong belief that growth will remain strong in the future. Taking a look at this larger chart, going into 2018, the dark blue line, there was an overall positive trend in the economy. But if you go back to like July 2000, which is the red line, it's fairly flat, or even October 2007, the orange line, where it's actually inverted. Now, these are generally indications that something is up and not going well. And then when you see the inverted curve like February 2011, the green line, that's generally a sign that the overall economic outlook is not good and that there's not a lot of belief in the next few years. So learning how to read this curve can be helpful in understanding when the market is entering or recovering from tough times. And generally, most investors reference this curve as an overall health indicator for the economy. Now, something else to be aware of when dealing with currency and banking are that the banks themselves can actually generate and create currency. Now, they do this through something called fractional reserve banking, and fractional reserve banking allows for banks to only hold on to a portion of their deposits. And right now it's set at 10 to 1. So what that means is that if you go to the bank today and you deposit $1,000, the bank is allowed to loan out $900 of that. They only actually have to keep $100. So before we go on to the next topic, obviously I can't just drop that on you without explaining it a little bit more. So let me give you a scenario here to think about this. If you have $10,000 in cash and you go and deposit that in your bank account, they only hold on to $1,000 of that. The remaining $9,000 they are not required to keep. So knowing this, you can begin to imagine some of the struggles that banks go through when there's a run on deposits. And it's one of the main reasons why banks fail and why FDIC insurance was created in the first place. So going back to our example, if they loan out the remaining $9,000 to another member of the bank, and that member decides to deposit the $9,000 and hold on to it from now, then the bank can lend out another $8,100. And if this process continues, suddenly a bank can create tens of thousands of dollars of loans while actually holding on to a fraction of the original value of their deposits. Problems then arise when the depositors come back and they need their $10,000. Say, for example, the individual is going to buy a car and needs to make a down payment. Well, when you come in to withdraw the $10,000, first the bank has to produce the physical cash for you, which they might not even have. Some banks even have rules where if you need over certain amounts of cash, you'll agree to give them time to produce the cash, and they aren't obligated to provide it to you right then and there. So it might actually take a while to acquire the physical cash, depending on how much you're requesting. The second thing you need to be aware of is that if the bank is now over-leveraged, then now the bank may no longer meet its cash requirements for the loans that they're giving out. So then they have to call in their loans in order to resolve their deposit issues. So if you have a loan with that bank, now there's no more 5, 10, or 30-year term. Now they need the loan repaid in full. And the vast majority of us aren't going to be able to repay everything in full at a moment's notice. Now you could always try to get another loan from a different institution, but if you tell the bank you can't repay, they have to start the collection process, book their losses, and start to write down their loans. So during poor economic conditions, This can really spiral out of control and cause banks and their customers to go bankrupt and lose everything. Now, the US government, certainly they've established and they regulate FDIC insurance to provide guarantees for deposits up to $250,000. But that doesn't deter banks from taking on too much leverage. Now, no one wants to ruin their business, and bankers aren't doing this because they're greedy. Even in good economic conditions, what seems like a small earthquake might just be the makings of something much larger. And unfortunately, a lot of times you'll never see it until it's too late.